Here is the script for BYND Meat, ticker BYND. The stock closed the most recent trading session on Friday, December 5th, at exactly $1.22 per share. This represents a downward move of roughly 2% on the day, capping off a week where volatility returned to this name with a vengeance. We are looking at a market capitalization that has shriveled to just over $550 million. A figure that would have seemed like a rounding error just a few years ago. If you are watching this while the market is closed, these are the final numbers from the Friday bell. If you are tuning in later, the volatility we are seeing suggests that $1.22 is merely a temporary resting point on a chart that looks more like a geological cross-section of a cliff than a financial instrument. The expectation for BYND Meat has always been anchored in a grand, almost moral narrative. The story pitched to investors was that this company would fundamentally change how humans consume protein, replacing industrial animal agriculture with pea protein isolates and extruded vegetable fats. The expectation was that we were looking at the next Tesla stock or NVIDIA stock, a company that would define a generation of consumer habits. Investors believed that partnerships with McDonald's and Yum brands would validate the technology, that economies of scale would bring price parity with beef, and that the total addressable market was effectively every human mouth on the planet. Retail traders on the Robinhood app and forums piled in, expecting that even if the financials were messy now, the sheer inevitability of the plant-based shift would carry the stock back to its all-time highs of over $200. The reality, however, is a brutal lesson in consumer economics and balance sheet gravity. The reality we are analyzing today in December 2025 is that the demand for faux meat has not just plateaued, it has evaporated among the mass market consumer who is price-sensitive and skeptical of ultra-processed ingredients. The reality is that BYND Meat is no longer trading on the promise of food technology. It is trading as a distressed asset engaged in complex financial engineering to avoid bankruptcy. When you look under the hood, you do not see a growing food giant, you see a company that has burned through cash at an alarming rate and is now resorting to massive share authorization increases up to 3 billion shares to keep the lights on. This is not about selling burgers anymore, it is about selling stock to pay off bondholders. Let's look at the immediate price action. This past week saw a sudden violent spike of 22%, a move that trapped many short sellers and lured in fresh retail capital. You might have seen notifications on your SoFi Invest app or Fidelity mobile app flagging BYND Meat as a top mover. But you have to ask yourself, what drove that move? Was it a new product launch? Was it a surprise profit? No. It was a technical squeeze in a heavily shorted stock, exacerbated by the news of debt restructuring. The company effectively swapped hundreds of millions of dollars in convertible notes for equity. On the surface, reducing debt sounds positive. It removes the immediate noose of repayment, but the cost is dilution on a scale that is hard to comprehend for the average shareholder. By authorizing billions of new shares, the slice of the pie held by existing investors is being cut into microscopic slivers. The stock jumping on this news is a counterintuitive reaction that often happens in distressed memes, the dead cat bounce, where the market breathes a sigh of relief that bankruptcy is not happening tomorrow, ignoring the fact that the equity value is being permanently impaired. The trading volume we are seeing, over 100 million shares changing hands in a single session, tells us that this is now a battleground for day traders and algorithms, not long-term investors using Schwab Intelligent portfolios or building a retirement nest egg. Institutional activity has largely been on the sell side or the short side for months. The big money left the building a long time ago. What remains is a churn of speculation. When you see a stock trading at $1.22, you are in the realm of option-like outcomes. The equity either goes to zero or it stages a miraculous recovery. There is very little middle ground, and right now the macro environment is punishing. Food inflation has forced consumers to trade down. They are not trading down to premium-priced plant-based burgers. They are trading down to chicken, private label meats, or cheaper vegetable proteins like beans and lentils. The value proposition of BYND Meat, expensive, processed, and simulating a product that is currently cheaper to buy in its natural form is broken in this economic cycle. We need to talk about the business model itself, because this is where the tension between the narrative and the numbers is most acute. Beyond Meat invests heavily in R&D to mimic the texture and flavor of muscle tissue. This is expensive science. It requires high-grade ingredients and complex manufacturing processes. Unlike software companies like Apple stock, where the marginal cost of the next unit sold is near zero, every Beyond Burger costs a significant amount to make. They have struggled to achieve gross margin positivity, meaning in some quarters they have barely made money on the actual product before even paying for marketing, headquarters, or R&D. If you are using Interactive Brokers trading platforms or checking the data on your Fidelity brokerage account, look at the gross margin trends over the last 8 quarters. You will see a company that has no pricing power. When they lower prices to compete with beef, they lose money. When they raise prices to cover costs, volume collapses. They are trapped in a pricing box with no easy exit. Contrast this with the broader market. Investors holding Tesla stock or even volatile tech names are used to the idea of growth at all costs, but that growth usually comes with expanding margins or a clear path to dominance. Beyond Meat is shrinking revenues. In the third quarter, revenue dropped 13%. You can't value a company like a tech growth story when its top line is shrinking. That is the hallmark of a declining business, not a disruptor. The partnerships that were supposed to be the saviors, the fast food rollouts, have largely been relegated to limited-time offers or test markets that never went national in a permanent way. The McPlant did not become the Big Mac. It became a niche item. This failure to cross the chasm from early adopters to the mass market is the single biggest fundamental issue facing the stock. I want you to pause for a second and think about your own portfolio. Are you holding this because you believe in the mission, or because you're hoping to get your money back? Comment below how many shares of Beyond Meat you currently hold and what your average buy-in price is. I am genuinely curious to see how many of you have held through the drop from double digits to $1. Now let's discuss the financial engineering aspect, because this is what will determine the stock price for the next 6 months. The company recently increased its authorized share count from 500 million to 3 billion shares. You do not authorize that many shares unless you plan to use them. This is a signal that the company intends to raise capital by selling stock into the open market, likely through at-the-market offerings. This creates a constant headwind on the share price. Every time the stock rallies on a bit of momentum, the company can step in and sell new shares to raise cash, effectively capping the upside. It's a survival tactic. For a trader using Robinhood Crypto or Robinhood Cash Management for liquidity, this stock might look cheap at $1. But if the share count triples, the value of that dollar share is diluted significantly. You might own the same percentage of a shrinking pie, or rather, a pie that is being sliced into 3 billion pieces. We also have to consider the role of the retail investor versus the institutional algorithm. Platforms like SoFi Investing and Robinhood Investments have democratized access, which is fantastic, but they also expose individual investors to these high-risk, distressed situations. In the forums, you will read theories about short squeezes, gamma squeezes, and hidden value. While short interest is high, often hovering around 30 to 40% of the float, a short squeeze requires a fundamental catalyst to sustain it. A squeeze without a business turnaround is just a temporary spike that lets smart money exit at better prices. If you are managing your own funds via self-investing or online investing sites, you must distinguish between a trade and an investment. Beyond Meat right now is a trading vehicle. It has volatility, liquidity, and range. But as an investment, it falls into the category of turnaround or bust. The macro hurdles are also worth expanding on. In 2025, we are seeing a consumer that is extremely discerning. The novelty of plant-based meat has worn off. It is no longer a status signal to buy these products. It is just another option in the grocery aisle, and often the most expensive one. The health halo has also slipped. Competitors and critics have effectively pointed out the long ingredient lists and processing levels. Whether that criticism is fair or scientifically accurate is irrelevant. The perception has shifted. Perception drives sales. For Beyond Meat to regain its footing, it doesn't just need a new burger recipe, it needs to rebrand the entire category. That takes marketing dollars they simply don't have right now. They are cutting costs, slashing marketing budgets, and reducing headcount. That is necessary for survival, but you can't cut your way to growth. Let's look at the competitors. The space is crowded with private label options that are good enough and significantly cheaper. The big protein companies, Tyson, Cargill,